everyone. My name is Lindsay Shuck. Thank you for joining today's Family Office Network's webinar series featuring IndexIQ and CANDRIAM. Before we jump into today's presentation, I would like to briefly introduce our speakers. First, Chris Hempstead, Director of Institutional Business Development at IndexIQ. Before joining IndexIQ in 2019, Chris led ETF sales at Deutsche Bank Securities and served as head of ETF sales at KCG Holdings. Chris has 20 years of experience in ETF and market making. Keith Dixon, head of International Business Development, is also joining us. Keith is responsible for the strategic implementation of CANDRIAM's corporate strategy in North America and Asia. He joined CANDRIAM in 2015 from Cheyenne Capital Management, LLP, where he was partner in the business development division from 2011. At the end of today's presentation, we will have time for Q&A. Please use your questions chat option on your screen to send over any questions that you have so Chris and Keith can answer them accordingly. And with that said, Chris, I'm going to let you take it from here.
Great, and thank you so much, Lindsay, for your kind introduction. And I'm so happy to be here today with Keith. Keith is a true, expert in this field. He's got a lifetime of knowledge and experience in the ESG and responsible investing universe. So we're very lucky to have him as our partner. We're very lucky to have him here, to bring his expertise to this audience. And so with that, Keith, listen, I think I speak for, not everybody for sure, but I think a lot of people, we hear ESG, we have a thought in our head of what that is. We hear lots of terms juggled around. We hear lots of different things: social investing, impact investing, diversity, inclusion. There's so many different adjectives or taglines that go with what we think is ESG. Can you kind of sort through that a little bit and make some sense of that for us?
Sure, Chris, and thanks very much for having me on today. Really, this slide captures a tiny element of the names that get banded around, or the acronyms that are used by people when generally they're speaking about, in the broadest sense, a very common theme. Investors are becoming increasingly interested in strategies that incorporate non-financial factors into the investment process. And all of these strategies really and approaches fall within the broad terms of ESG investing. But there's a huge number of different approaches and different names to describe them, acronyms. We've listed a few here. It really, starts back in the days of values-based investing through social and responsible investing, or SRI as it's commonly known in Europe. And then you have people focused on green investing, more recently impact investing, which we're going to get into shortly, and responsible investing, mission-related investments. And it really depends who you speak to, where around the world, and what term they use. But core among them is ESG. And really, we found, there's a 2017 study that showed that half of the investment firms, when they were asked about the terminology they were using, there was confusion internally. So it's not only the people out there that are looking to understand what they can buy, but also those practitioners. And often when you get into the nuts and bolts of it, you find that two ESG practitioners may call it different names, but they're talking about exactly the same thing. So it's really key to break out and define that quite clearly and have a strong understanding from a purely education theoretical basis about what people are focused on and what they're talking about when they come up with any singular term. So we're hoping to help sort of clarify some of that for you today.
Well, with that in mind, and you brought up ESG as a core to all of these other sort of philosophies and acronyms. Can you break us down the E, S, and G, in a way that maybe we haven't thought about it?
Sure. So I like to think of ESG investing as the broad philosophy, and the E, S, and G, the environmental, social, and governance elements, as kind of the toolkit. It's a lens through which you can look at companies, the way they the way they act, the way they engage with their stakeholders, and undertake some of that non-financial analysis and understanding. And so really the environmental focuses on, quality and functioning of how they interact with the natural environment. Greenhouse gases is the most famous and obvious one to pick on, but climate change, very topical, element people are really focused on, particularly when we see these huge fires in California, for example. There's a lot of debate about it in the political sphere, but also in the investment space, renewable energy, and some of the thematic plays that come to life in that space, energy efficiency. And more recently, there's a dialogue coming up around waste management. We consume a lot of goods. How are we looking after the rubbish that we throw out? What do we do with our old iPhones, etc.? That kind of falls within the environmental section. Also very relevant, and particularly more recently, is the social aspect. Issues relating to rights, well-being, communities, human rights, labor rights, workplace health, but increasingly, gender, race. These are key elements around the social aspects one could look at, and that's been particularly prevalent in Black Lives Matter and other campaigns and awareness programs and movements that have been coming together very recently. But it can go through to as simple issues as if you're analyzing a company in the construction sector. Do they look after their employees, their workers? Do they count how many accidents they have? So it can be headline, big, broad social issues, or it can be real practical, on the ground, individual issues that you're focused on. And then governance. Issues relating to governance of their companies, how they put in place policies and deal with their stakeholders, board structure, size, diversity, skills, and the independence of board directors and oversight. Governance is perhaps the most classic of the ESG that is incorporated in everyday investment. For example, if you spoken to your portfolio manager, or you invest in a product, said we ignore corporate governance in our companies, you would walk out, you'd laugh at them. But it's how you do it in a structured, systematic process that really counts. So these three elements are, again, quite broad topics. They capture a lot of elements within them. That's why I say I think they're the beginning of the toolkit that allows you to understand companies without just purely looking at their balance sheet, but how do those companies act and how do they engage with others?
Yeah. And I'm going to shift gears here just a second, and thank you for that, Keith. As always, no matter how many times I hear you present or I read some of the content that you provide, my mind starts to spin a little bit about all the different variations that could come out from the different, E, S, and G thoughts. But with that in mind, and shifting gears a little bit, you've been doing this for a long time. CANDRIAM's been at this for a very long time. Where are we in the growth stage? I mean, I think, it's obvious there's been a lot of headline and the assets going, to ESG, but can you, touch on that a little bit more eloquently about where ESG is in the investment universe now?
Sure. Well, ESG is like you rightly say, it's getting a lot of attention right now. But we've been doing it for 25 years, and that's a small time frame in the grand scheme of things. When you really look back at, ESG started, the investing started with a number of the endowments and foundation communities seeking to, through student pressure, exclude countries from their investment portfolios, like South Africa and apartheid South Africa. But then it's really evolved from there. And, now we view it globally as around 30 trillion in assets, 30 trillion of assets. This is not a niche. This is the biggest niche I've ever come across, if it is. It's a huge space, managed within some sort of ESG investment process. Now that's a large number, and again, it depends how you define ESG. But of that 30 trillion, 12 trillion is in the US. And so that's a very sizable element that is managed in both institutional and in retail, in funds, in ETFs. It's really, really growing. And we've seen this growth, particularly in the number of mutual funds and ETFs that have been launched, really take off in the last few years. There's been a significant number of products brought to the market, but also a significant number of assets flow into the space. You know, Morningstar are estimating there's around 350 mutual funds and ETFs following this process. That's a huge growth. And when you look at their statistics, it was a steady growth over the last 10 years, but the last 2 or 3 years, it's really jumped. And you know, you can see that statistic we have on the slide of 50% growth. But you know, when you look at the flows through Q1, Q2, and I would expect it through Q3 of this year, through the market correction, the early part of the year, there's been consistent flows, positive flows into the ESG space, particularly in the ETFs and mutual fund. And it's really caught on in a very big way. And that sits alongside the big institutional allocations that have been happening over the last 2 decades.
So that begs the question, and I think I've asked you this before, but of the 30 trillion globally and the 12 trillion in the US, it's not all one kind of ESG investing. There's a couple of different flavors of that. And again, this is in terms of education, which I can't get enough of. This is always helpful to hear you go through this next set of terms: integration, exclusionary, inclusionary, impact. These are all very important lenses in the ESG world. So can you take us through this, this thought stream and help us understand what each of them are and where they sit?
Sure, definitely. And this is where I think so much confusion comes in the space. It's so great to have a session like this where we can share some of the insights and help people understand what different practitioners are talking about, but also the different methods you can apply this broad philosophy into your investments, and vehicles come into that, approaches. But if we start at a high level, ESG investing, I call it, is the umbrella term. I think it's globally recognized, ESG, this particular taxonomy has just recently been accepted by the ICI, which is an organization with some of the biggest asset managers globally participating. But you start with ESG as the headline sort of philosophy, and within that you can make 2 clear distinctions. First of all, number 1 is ESG integration, so not investing but integration. And what that means is you take this non-financial information from the E, S, and G, and you use that in assessing the value you give to a company and its equity security or the bond. So you take that information and say, if I want to invest in company A and company B, I'm going to take some extra non-financial information to help me put a value on each company, rather than purely looking at the balance sheet and future sales or return on equity in the equity space. The other side is what we generally collect together as sustainable investing. This is strategies that systematically consider ESG and are significant to that fund's investment thesis, rather than purely the value attributed to a company, and then you build your portfolio separately, so that you can respect either individual investors' values and you seek financial returns at the same time. So the way I split it out is ESG integration focuses on value, the value of a company, and sustainable investing can incorporate ESG investing, but also focuses on some element of values. Now, we don't define values explicitly here, but it can be ethical values, it could be moral values, it could be a value around excluding a certain sector like tobacco. We don't want to sort of pick up on that individual word and attribute some definition, but we leave it broad. Now, within sustainable investing, you have exclusionary investing, which is that exact example. I'm going to choose a portfolio and we're going to exclude tobacco stocks. That's a very clear, you just push out one entire sector, for example, and you invest in everything else irrespective. Great example of that was CalSTRS and CalSTRS about 10 years ago. Inclusionary investing is where you try and identify those companies that are more progressive on ESG, and you choose to invest in those, and you remove only those companies that you feel are less progressive. And then finally, impact investing. Impact investing is the one where you try to identify companies that can deliver a measurable, and I highlight measurable because I think the measuring is really important, social or environmental impact as one of the objectives, and it may supersede your ambitions on the financial returns. It's unlikely to completely dilute it, but you may say, I'm willing to actually give up some financial return to have a bigger social or environmental impact. And here you often get it traditionally in the private equity space or real estate space, but increasingly this is coming to the fore in more liquid forms in equity, in ETFs, and in thematic funds. And underlying all of that is what we call stewardship. This is voting when you own a share against or for policies put forward by the companies. Typically, it's around pay of senior management and board directors, but also engaging with companies and saying, look, we don't think that what you're doing here is great for the environment. Have you considered trying to mitigate your environmental impact? Or your peer group that that you compete against have been really quite progressive in this part of the business. Why don't you try and learn about that? And that sort of runs through all of it. I think that's important because stewardships, we are owners of companies. We may be asset managers or individuals that own companies, but we're owners, and we can ask them to change if we shout loud enough. And that's what stewardship and engagement is all about. But if you dig in a little bit more, and I think if we click onto the following slides, we can do that. Exclusionary investing, as I said, really seeks to have a positive ESG outcome. You're trying to find the companies that are more progressive with ESG, believing that those companies that are more progressive in terms of how they deal with their employees, what's their work at home policy, are they supportive of working at home? If they do that, they're hopefully going to get less illness with the COVID crisis because people aren't traveling on public transport. That company is going to be able to be more productive than its peer group, and therefore its returns will be better in future. That's a more sustainable philosophy. It's a more sustainable business. There's a number of different ways. Oil and gas is an example, where you might choose to find a company, an oil and gas company that has a higher percentage of their revenue generated from renewable energy. Not 100%, but a higher percentage, because as that political pressure, regulatory pressure, consumer pressure builds, they're slightly ahead of their peer group in terms of having renewable energy. They're going to be developing more technologies earlier. They're going to be more sustainable companies as a business model in the long term. And that's what you're trying to invest in, removing the companies that you feel, or through an ESG analysis, feel is slightly behind the curve, as it were. So really, this inclusionary investing can include classic screens, but rather than screening out bad companies, entire bad companies, you're screening out the relative bad companies. So you're not saying we're going to take out, we won't take out every oil and gas company, but we will take out the 20% or the 30% worse oil and gas companies, and we'll focus on those that are more progressive. And that I think is the future, and how sustainable investing is evolving going forward.
Yeah, you can think that maybe if you think of the oil and gas industry, if there's good eggs and bad eggs in a sense in the ESG lens and the inclusionary lens, it probably incentivizes those that are not part of the inclusionary screening to do better and to change the way they behave, as opposed to just ruling out the whole sector.
Exactly, but also you're facilitating capital to those good companies, the better companies. You're buying their stock and you're engaging with them, or if they're issuing bonds, you're buying their debt. That allows them to have a lower cost of capital. So it's kind of, it's positive reinforcement, rather than we're totally going to exclude you from our portfolio, and if we turn our backs on you, well, if you don't own the company, you don't have the right to ask them to change. But if you say, look, I own company B that's got a better ESG profile than company B, you can go and talk to company B and say, look, if you changed your policies, I could buy you, and I'm a great long-term shareholder. And it's that stewardship engagement, but it's about who you choose to invest with. Exclusionary investing tended to be how it was done in the past. It was quite a simplistic application, and there are rationales and methods for doing that. But if you really want to have a proactive approach, then inclusionary approaches are much stronger.
Yeah, it definitely sounds like inclusionary is more along the lines of our traditional activist nature, in a sense, as a shareholder.
Exactly. But the key is doing it in a more a systematic, formulaic way, and that really builds out that peer comparison. It's not an absolute determination; it's a sort of peer group, recognizing that not everyone's perfect, but some companies are better than others. And really where that comes out, at the end of the day, is choosing on impact investing. And this is where you are trying to deliver those measurable social and environmental impact, as well as generating an acceptable financial return. And you can see on the left-hand side of this slide, we've highlighted how you have alignment, that is aligning your investments with your values, avoiding questionable exposures, tobacco, chemical and biological weapons, the real nasties, maybe optimizing it through through inclusive selection on exposures you do want, the more progressive companies, through to impact, which historically again has been very local, quite illiquid. People wanting to substitute a charitable endeavor in their local city or town, but really increasingly is coming to liquid securities. And it's been fantastic to watch over the last 15 years as more people have got involved in this. It's more regional and global. And here we're trying to target companies or sectors that have a very specific social and environmental impact, and to have a direct impact and be able to quantify it. And that's always important, because if any activity you undertake has a positive effect, you hope, but it also has opportunity costs and secondary effects. And it's really important to measure that within impact, because you want to be reinforcing and offering capital to companies that are doing something positive for the globe, for the environment, for local communities. But at the same time, by giving capital to them, you're not giving it to someone else, but also is it having a secondary effect? And that's where impact has to be. The key is measurement, and that's really important within impact.
Measurement would be a part I'm definitely going to ask you more about measuring, because I feel like someone could always play devil's advocate and say, well, what about this and what about that? There seems to be a very hard. It's not a fine line, right? There is no black and white, 0 and 1 binary result, right? It is. I don't know. Would you talk to that a little bit?
Yeah, it's true. I mean,
slide. There's a lot of inputs that go into measuring.
There's a lot of inputs. There's a lot of different, like within ESG, we've broken it down into the sort of 4 or 5 ways you can do it. And then within impact, you have, here you go. This slide shows it, a huge range of different ways of doing impact investments. From pure liquidity, where you can do it in money market, through income, growth, inflation, but also there's so many different elements that you can touch, focus on energy, water, the community, fact, and you go back to Black Lives Matter and people saying, well, support, Black-owned businesses. That is an impact statement, and that is an intention of impact, but it's also measuring how that comes out, and health and wellness, providing education to perhaps in the third world to people about, clean water, and how do you do that while balancing it with also trying to generate a financial return? Because this is not a charitable donation. You're seeking to generate those positive, acceptable returns whilst having that impact. And so it's very important to define what impact you're seeking to have and where and how it fits within this sort of metric. And it's not exhaustive, but it's pretty comprehensive. And then really focus on the measurement. And this is where I get really enthusiastic about it, because if you flick onto the, I think it's the following slide with the SDGs, you can, people often come up, and we're great at creating another acronym, SDGs, the Sustainable Development Goals. It was brought up by the UN, represents 17 broad global goals to be met by 2030. And a lot of people, well, what about SDG investing? how do we do that? How does that fit within ESG? And we come back to this issue. Impact is key towards achieving the SDGs. So in our world and the way we think about it, the SDGs are the blueprint to achieve a more sustainable and future for us on the globe. I mean, they're very broad. No poverty. That's a very broad and quite hard theme to focus on, say, impacts. I mean, we could argue that any one person, if you own a company and pay a salary, you're helping that individual avoid poverty by giving them a salary. Or you can say we're actually going in and finding companies that guarantee to pay a minimum wage when they are manufacturing in Bangladesh, for example. So it's very clear how you can have impact. Since funding for all of these is never going to come from governments, from NGOs, and charitable organizations, it's going to be down to the private sector, the individuals and investors and capital is going to have to flow from individuals, households and businesses to really make the difference in this. And the UN estimates that the SDGs are going to require $5 to $7 trillion invested just to meet them by 2030. That's a phenomenal amount of money. And so if we're going to be choosing an impact approach, being able to measure that and how we are calibrating how we're doing towards those SDGs is crucially important, because we need an honest yardstick to say, yeah, we're making an impact, but it's maybe not as much as we'd hoped. We're making an acceptable return. Is there a trade-off there? Okay, or actually we're having a great impact on gender equality. But that's having an impact on a negative impact on another SDG elsewhere. So we have to sort of focus on those and see how we can bring what people are called the total societal impact, TSI, and quantify that as a whole holistic picture. And that's the key about impact and measurement.
Well, you mentioned trade-offs, and there's 17. Is that right? There's 17 SDGs. Yeah. So for someone to score high on all 17, I mean that's a euphoric moment, I would imagine, for a manager and for consumers of that. But there is trade-off. So I guess that does beg the question. How does, if you can envision this as a report card of sorts, how do those who measure? This is a reporting element, I would imagine, or something of that sort.
Yeah, I mean, we've included here this is kind of some of the metrics that we use that talk to some of the key elements that people are most familiar with, firstly, and secondly that we find they're most responsive to, and we've trying to demonstrate it in a form where people can understand it quite simply, rather than saying, if I'd say to people, well, we're measuring, carbon footprint in scope 1, 2, and scope 3 elements, to the individual on the street, that means nothing. They are aware of climate change and carbon footprint, perhaps, but the different levels and what goes into them and measurement is quite difficult to comprehend. So, in trying to make some of that reporting and impact measurement real to people, if you say, right, your portfolio versus a benchmark has a average 25% less carbon footprint, they start to understand. And then you say, well, that's the same as taking 15 trips between, I don't know, Paris and Stockholm. Then they're like, wow, okay, that's that rather than driving, rather than getting the plane from New York to San Francisco, think of other ways you could do it, or we can tell you how much your portfolio is saving you. You can do the same for water, which is increasingly becoming important. But also we can do it in terms of gender and board representation. What percentage of women are on the boards of the companies that we own versus the broad index? We're never saying that we're going to have only those companies that have 50-50 gender equality. But we aim, or the outcome of our investments and impact is to have a higher proportion than the nearest benchmark. And so that makes a real, it allows people to quantify it and feel it in their daily lives, which is important, because some of these concepts are are quite abstract, they're quite long-term, and we don't feel them on a daily basis. We'll feel them marginally on an annual basis. But as we can see with the temperature rise in the globe generally, it's something that people are focused on and want to be able to understand.
Yeah. Is it working? I guess that's, I'm walking you down this next one, but that's the big question is, does it work?
Yeah, I think we've made a start. I'll be honest. I think it's that there are organizations out there that do a fantastic job in sharing that information. It's always evolving. So yeah, short answer, as we say, is yes. It's more complicated because many people want to focus on different metrics and different metrics resonate with them. As we said, there's no fixed way of defining ESG as it's such. There's a loose agreement. Same with impact reporting. There are more and more programs and associations and agreement being put in place, but there's no collective agreement yet. It's not like if you look at a financial balance sheet of a company, you have a pretty, there's pretty well recognized set of metrics that you would look at: return on equity, debt ratios, leverage, etc. But when you get to ESG reporting and impact reporting, they're not as closely agreed upon, but they also don't always make sense. Because if a strategy is focused on water, you don't really need to worry so much about the gender equality. That's not the ambition of the strategy. But then if you have a broader space, investment strategy, both of those might be captured within the one product. So it's getting there. From studies that have come out, people are expecting market returns for impact investing. 2/3 want market returns, and they want the reporting and the impact alongside that. But if you're giving up 1/3 of your market return, you kind of want to know what you're getting for that.
Yeah.
And that's where that reporting comes in. So the impact dimension is really important, and it's evolving. We think it comes back to education again. Highlight this to people. They'll ask for more of it. They'll demand it of those that don't provide it. They'll encourage those that do. And you'll see it roll out more broadly in the space. I think that will have the impact that many of us involved in this space are really hoping for.
Now, in terms of, you touched on some of the metrics: $30 trillion, $12 trillion in the U.S., but that's ESG, not necessarily impact. Impact is still a very small percentage of that in that overall footprint. So what's your thoughts on the room for growth? Where is this going? Impact investing, is it going to hockey stick up in terms of uptake?
Well, we'll see what the SEC comes out with and their recent regulatory inquiries and whether that makes a difference. But impact investing today, we see it around 500 billion. I think was the latest study I saw in 2018. So let's put that in context: about 2% of the overall 30 trillion globally. So it's a very small amount, but it has the potential to have the greatest impact because it's focusing capital, and so I think it has a disproportional sort of return on impact or ROI is a different way of defining it than you might have for broader ESG integration, for example. The asset size may not be as large, but the impact is going to be magnitudes of. Particularly when it's done at a focused regional or local level. So we see this as an area that's going to grow really significantly. The UN SDGs, Sustainable Development Goals, require trillions of dollars of investment a year. So capital will naturally funnel that way. It's very attractive to individuals as well as larger institutions and corporations. It then really comes down to how do they access it. There's been this shift from illiquid impact to more liquid impact in mutual funds and ETFs, and I think that's only going to drive that return. I'm not sure if the hockey stick analogy is quite right. I think it will be a gradual increase, but a year like this year where people have seen the impact of COVID-19, when they've seen the California fires, when they've seen record temperatures globally, people are becoming conscious of this, and they really want to get get into it and understand it. And that's the first step. That's why I go back to that. There's room for growth here, but people need to understand what they're doing and how they do it. And hopefully, we're part of that conversation.
And you've broken down for us a very interesting slide as to, of that 500 billion, or that smaller percentage, where is it landing? And this is an interesting graphic and visual of where that impact money is going.
Yeah, and I think this is what you're going to see is the colors that are probably not in green and sort of the orangey private equity side. I think those are the elements that are really going to grow. When we look forwards and see that growth, I think debt, real estate, and private equity are going to be squeezed down because people are really looking for more liquid ways to do impact, but also in more creative ways in different structures that are perhaps more accessible to wider populations in the investment community, but also because there's more demand. As we deliver the 6 to 7 trillion a year, the SDGs need, there's going to have to be evolutions and people trying new products, and so we'll really see that break out. But yeah, this is I think a very good, a snapshot of where it is today.
Yeah, and that kind of segues into one area that we touched on. Still, again, overall, very small part of the 30 trillion, but ETFs in general, near and dear to my heart as a lifelong ETF trader and market maker. But no surprise that more and more products are coming to the market from the largest and the smallest managers with an ESG lens and an ESG focus. The growth of assets in the ETF wrapper in and of itself has been astronomical over the last 15 or 20 years, and now add to that in ESG, it's following right in the footsteps of overall ETF growth. The vehicle itself, the tax efficiency, the transparency, the access to liquidity, we think are some of the driving components of the success of the ESG ETFs that have come to market. I think one stat, Keith, that again just resonates weekly with me is the net inflows in this very challenging year.
Yeah.
In a year like 2020, I wouldn't have expected people to be changing a lot of their investment mandates. So, I'm going to wait till next year to make big decisions like that. I'm going to go from non-ESG to ESG or whatever that might be, but that's quite the opposite. I couldn't have been any more wrong in my assessments of where that would be. But 38 billion, at the time we printed this, of net inflows just this year alone in a category that is infinitely smaller than the broader 2,300 ETFs that are available in the US today. So there is concentration. I think there's a ton of room to grow. We've got some products out there by CANDRIAM in an ETF wrapper that are doing phenomenally. So, we're very happy to see the market accept the ETF wrapper in ESG. The liquidity is, these products, at least the ones that we've seen come to market to date, our own and others are incredibly liquid. Again, with anytime I talk about ETFs, it's very important for me to remind everyone that the volume that you see or the assets under management are in no way indicative of how much you can invest. The amount you can invest is what a market maker is willing to create for you, which I can assure you is a very, very high bar to get them to go away. Plus, most of the indexes that we're looking at or the products that we're seeing in the market today anyway that have that ESG classification, the underlying assets are very liquid. They're companies you're familiar with. They're securities you're familiar with. So it's not challenging market makers to provide liquidity. So again, I would look under the hood, look at the managers, get comfortable if it's something that you're looking at in the ETF wrapper. Find the one that fits. Find the one that works for you, and take a look at the managers. Again, look at their history, look at their performance. And then ask your trading desk how much you can do, because I think you'll be surprised at how liquid these products really are. Keith, I don't know if you want to add anything to add about.
I've been really blown away this year by the attention and the flows that have come into the ESG space, particularly in the US, where for so many years people have talked about it. Oh, it's playing catch up to Europe, and I'm in London today, and I've witnessed the growth in Europe over the last 20 years, but to really see it take off in the US in the last couple of years, but particularly the first 8-9 months of this year has been fantastic to see. And really what I've appreciated is in the products that have come to market, you've seen in the market correction of Q1, better drawdown protection, and then they've captured those returns on the web, as well as being ESG in their various forms. So you're kind of getting the best of both with a little bit of lower volatility, and that's where this outperformance versus, say, an S&P 500 has come through, but you're also now able to get it in a really liquid format. So it's, you can buy in, you can change it, you can trade it around, and there's some really attractive pricing out there in the market for the individuals. So I think it's fantastic to see. I echo exactly what you just said.
That's great. Now listen, as we're getting towards the end of the presentation here, but I want you to touch on value-driven investor. This is important. It's unique in a sense. So why don't you walk us through a little bit about that concept?
Yeah, sure. So CANDRIAM and New York Life undertook some very detailed research in 2019, and the conclusion was that we identified a subset of investors. I mean, 53%. So let's say just slight majority, but half of them, who identified themselves as values driven. That wasn't meant that they had a particular religious value that they adhered to or a moral value. The way we defined values was they had in their personal lives, in some capacity, made a decision to boycott a brand or support another brand. Let me give you an example. Someone goes out and they want to buy a new pair of trainers, and they say, you know what, Adidas do a trainer that's made out of plastics recycled from the ocean. I'm going to buy that Adidas brand trainer. That was a values decision. We define it as values consumer. Or they go into the restaurant and they're ordering their cola, and it comes around with a plastic straw, and they say, actually, I don't want to use a plastic straw. I'm not going to have another plastic straw in there. They've made some sort of decision in their personal lives that defines a value, that they are focused, they're worried about those plastic in the ocean. So we went through, and this values-driven investor represents just over half the population. They're highly diversified, and what was key to us, if we flick on to the next slide, was 50% of those were open to ESG investing. So they wanted, but the key was discussing it with a financial advisor or someone they felt was more educated and could provide them with an understanding of what was going on and could help walk them through their options. So broke it down. 44% of those we identified were aware of ESG and sustainable investing, but only under a third had actually invested in an ESG fund of some kind. But when we asked them, would you be interested in discussing it, a huge number, again, over half said yes. And we dug into that again, and we identified that they're on page 20, I think it is, the deck. They needed a bit of help in understanding how to construct a portfolio. Not all of them knew how to reflect that values in their portfolio, but most of them confirmed that they'd be willing to take an element of adjustment to their performance, or would consider aligning a performance target with a value, which is very much different from saying I'm going to give up my financial return to have an impact. I understand that. I just want to be aware of what the potential for return is if I choose this strategy, and that's something very important, because a lot of people get caught up in ESG investing is, well, I'm giving up all my returns. It's not, as long as you understand when you're going into the investment what the outcome should be. That's why the measurement is key, and that come back to the education. But they then said the key was really to focus on the understanding it, and so they said they really wanted to speak to their advisors about it, and that was really overwhelming. But what was even more important for us was they wanted their advisors, their financial advisors or others, to bring it up to them. And that went back to our core element of education. People want to learn about it, but they wanted someone else to bring it up to them rather than them propose it, because they didn't feel confident in the education, in their own knowledge, and that's education.
Do you think advisors need a little coaching in how to bring it up with their clients, something they've never brought up before, or maybe they've skirted around it?
I think so. you know, I'm trying to do a lot of work. Key element we identified is the longer a financial advisor had a relationship with their client, the less likely they were to invest in an ESG fund. Like if you feel you've got something going, you're not going to rock the boat. Or if you've got a client you've been working for 15 years, it's a bit awkward to go back and say, let's just sit down and talk about your core values. But those clients still want to have options brought to them. They just want options put in front of them, educated about what the options are and how they might go about it, both in terms of ESG style and strategy, but also in terms of vehicle. And so, you know, for us, at the end of the day, what we concluded was that awareness is key to the driver of this discussion. And really, once people are made aware about it, a third of them said they would likely invest in that fund. That's not a bad hit ratio for a financial advisor, given the increased female ownership of assets, and that's only going to grow, given the future when, you know, there's this huge transition of wealth from, say, the baby boomer generation to their kids. Those are the people that are going to be most interested in understanding and learning about what they can do in an ESG space. And advisors need to be educated to be able to have those conversations, simply so as to be able to maintain that business and grow their businesses. So we found it really important that they educate themselves.
And again, we keep bringing up the word education, and again, I think this applies to so many different areas of our investment options. But resources, Keith, we've got some great resources available. You want to just touch on them briefly?
Yeah, sure. So we worked very closely with New York Life to put these together. This is bringing 25 years of experience, you know, across the pond from Europe, and then making sure that we got our tomatoes and our tomatoes the right way around, and it's delivered in a format that suits you know, advisors. But we've brought the CANDRIAM Academy, which is an online portal, education portal, free to use, about ESG. We've had over 5,000 members take the course globally in 3.5 years, so it's really worked out well there. We've produced some essentials guides, which are short, you know, 3-4 page documents that really just break out the basics. Great for handing over at a meeting, you know, just taking through, people allowing them to take notes and make some, you know, some key decisions, or start that education process. And then we also, you know, help with some basic conversation starters. How do you start that discussion around, you know, exploring ESG with a client when you've known them for a long time, without, you know, taking it up, you know, just having the confidence to say, hey, let's have a look at this. Is this something you'd be interested in? 1 in 3 people will make a trade. That's an incredible statistic.
It really, again, I think that awareness, you know, that awareness piece is, you know, is half the battle right there.
Exactly.
Keith, I want to think, I know we're pressed on time, and in terms of questions, one of the questions was related to, you know, can you give us examples of companies that are excluded or included that you might be aware of? Popular news headlines around listed companies we hear about on CNBC. You know, vague.
Yeah, I mean, one of the classics, the one that I look to, I can tell you from our you know, focus, it is Facebook. You know, 18 months ago, they were in the headlines and on CNBC because of the data that was sold to Cambridge Analytica without the user base really knowing. You know, one of the hardest challenges in analyzing companies is through the corporate governance lens, is to understand where these sort of, this technically wasn't a fraud, but where these kind of elements might happen. And one of the key elements is oversight. Is there a strong independent board of directors? Is there an independent chairman? And in Facebook, that there isn't. And to us, that suggests that not that something will happen, but that there's a higher probability of an issue. And so we, you know, within our investment processes, can either screen it out, or we can put it in a smaller size, so we still capture some of those returns, but that we don't get the volatility from a fully fledged position. That's one. The other ones that always comes up is oil and gas. People get very, you know, caught up in that and the effect on the environment. You know, we don't want to exclude a driver of the economy like oil and gas in its whole as a whole sector. We need exposure to it in our portfolios. What we want to find is those companies that we feel are more progressive from an ESG perspective. So for us, something, you know, ExxonMobil would be in the peer group, kind of average against its peers. But something like Chevron, for example, might get screened out because they've had a higher number of controversies in the last 10 years. These are controversies where they've been drilling in countries where, you know, there may not be an international standard of law, and so, you know, there's been bribery cases, etc. And they don't seem to have put in place the policies to resolve that going forwards. So that's where we will take two oil companies and in a way kind of go, okay, we'll choose this one which we feel is more progressive on a relative basis rather than totally excluding it.
That's interesting. You know, you think about things that are out of our control as investors or advisors, for that matter, are regulatory and diplomatic, you know, sort of ingredients in this conversation. You know, emission standards, for example. You know, that's something that's sort of out of our control. We vote for politicians who you know, who align with emission standards that we want, but then it goes downhill. I mean, it goes down the chain from there to these companies. You know, how they get it out of the ground, and you know, they measure their refining capabilities. I think, you know, that we're in a great place, you know, in 2020, at least in the developed world, that, you know, the standards that we adhere to today with energy consumption and production are higher than they were historically, you know, during the earlier part of the Industrial Revolution. So we're heading in the right direction. So it's, you know,
it's important that, I mean, you know, governments can only make regulations that impact within their boundaries, their national boundaries. We, as owner of a company, can invest in a multinational that operates in 15, 20, 25, 30 countries, right? And we get to vote on their pay. We get to talk to the company. We can have an outsized impact, particularly if we band together and engage. That's that stewardship element coming through. And that's really key, that we talk to both companies in our portfolios, but also companies that we exclude. One, because the only way you're going to get the information on those excluded companies if you ask them, but also by saying, look, we'd like to invest in you. We want to show you what best practice is. Let's help you understand so we can be a shareholder of you. And that's how you slowly get companies that are not just the very best ESG companies, because everyone knows who those are. They're going to be well priced or overpriced in the markets to buy as a security. So you're going to, you may not get the best return for them. But finding companies that are in line, that have got a minimum standard. They're not the best, they're not the worst, but they're keen to and want to move forwards and improve themselves. That way we can get a financial return, because as they improve their ESG profile, others will notice them and buy them, and the stock price will hopefully rise. But also we have the knock-on effect on the ESG impact, where they are improving their business practices, they're improving how they deal with their suppliers, their employees, and there you get what we've termed ESG alpha. So it's not the financial alpha, we hope for that, and we design our products to deliver that for our investors, but also this ESG element, which we think will give the added benefit and deliver a more sustainable company over time, which, you know, if you compound that day in, day out, leads to a better overall return, hopefully with an element of lower volatility.
Softball question here, or what we call open net, you know, in European football. Do you think that at some point, because ESG, impact investing, and the sort is meaningfully purposeful right now, at some point down the road in our future, do you think by default most of our investment options will have a scorable ESG or, you know, impact measure, making it very easy for us to sift through the options? It would be, you know,
I think we'll move to standardization very quickly. I would say in the next 5 years, I think there'll be standardization reporting coming out. You know, a number of people are working to do it. I think that's true. My hope will be that in 15, 20 years, ESG investing is not a term that we need to educate people about, but will just be the way that everyone invests, like everyone looks at a balance sheet today. You know, if you go to a classic investment analyst or portfolio manager and say, have you considered corporate governance, yes or no? They say no, you'd fire them. But it's whether it's done in a systematic way And then on the back end, rather than just getting your monthly return figure, you get your return figure, and then you'll get your carbon footprint, your water impact, your gender diversification. That should just come as a standard, and people should see that as a more holistic way of investing in total. So I think we will get there, but it's a work in progress, which is great because that gives us an opportunity to talk about it to more people, and hopefully the more we talk about it, the more people are convinced and can take advantage of it now.
There's certainly a feel-good aspect to it. So Keith, listen, we're up against the hour here, so I want to thank you and thank all of our attendees for your time. I want to thank you for your insights, Keith. I can't reiterate enough. I get a lot out of these conversations. There's always some piece of retention with every repetition, so it's always helpful. If anyone, the attendees are looking for more information, if you'd like to have an individual conversation with Keith, myself, or anyone on the New York Life Investments team, CANDRIAM or IndexIQ, you can reach out to our representative at the Family Office Network, and we'd be more than happy to be in touch with you. So again, thank you for your time. It's been a pleasure, and look forward to talking again soon.
Thank you, gentlemen. Have a great day.